Hi class, welcome to lesson number 37. And as you know, we've been talking about macroeconomics for a while. Particularly, we've been talking about fiscal policies, how to fix economies, how to fix inflation using a fiscal policy, right? And until now, we've kind of shifted AD as well. Today, we're going to talk about how to hopefully shift AS using different techniques that supply-side economics talks about. But before I do, we do need to cover our homework question. Homework question was talk about the net export effect. And the net export effect links the fact that when the government borrows money from the public or the banks, what happens at the end is that actually AD goes down. But the net effect actually depends on how the US dollar is doing. And let me talk about the link real quick so that we can cover the question. What happens is the government borrows money, as you know, and the government borrows money because their goal, right? The goal of the government is to fix the recession, right? And the way to fix a recession is to make sure that the AD goes up. How does the AD go up? Well, if G goes up, AD goes up. The goal is if AD goes up, our GDP goes up. And that's how we can fix a recession, right? This is what an expansionary fiscal policy says. Now, the other side of it is that if the government borrows money, right, because they need to, because they want to spend money, right? They want to increase G, they got to spend. How do they spend? They got to borrow, right? So the government borrows money, okay? The government borrows money, and as a result of that, the amount of loanable funds goes down because they go to that market of the loanable funds and they say, hey, you know what? We need about $1 billion to, say, like bail the banks out. And so what happens is the banks say, fine, take $1 billion, right? And the problem is in the market of loanable funds, the amount that are available to loan out is going to go down because the government has taken a chunk of that. For that reason, the amount of loanable funds goes down, right? Now, when something is not as prominent, right, and it's not there as much, it's not as abundant, right, what's going to happen is it's going to be more valuable. And how's that going to translate in the market of loanable funds? Well, it translates to us as a higher interest rate, okay? Higher interest rates play through. What happens if they're higher interest rates, okay, is that actually there are going to be foreign investors coming in. Why do foreign investors come in? Because let's say the U.S. government borrows money. The U.S. government has gone into the U.S. banks and loaned out, and they have decreased the loanable funds, and the U.S. interest rates have increased as a result. Well, the foreign investors are going to come in because relative to other countries, if there are higher interest rates in the United States, it means that they're getting a higher rate of return on their bank accounts. So they're going to come in, bring their money into the United States so that they get a higher return back. So what that's going to do is that obviously it's going to create a higher amount of foreign investors in the United States, but at the same time, it's going to make the US dollar stronger. Remember, we showed a graph showing the demand and supply, right? And we talked about the price of the dollar, price of dollar in other currency, right? And we talked about the quantity of dollar. The point is that the demand shifts to the right, okay? And when the demand shifts to the right, what's going to happen is that the price of the dollar is going to increase. So the US dollar becomes stronger as a result, okay? If the US dollar becomes stronger, what's going to happen is that the purchasing power of the foreign countries is going to decrease because the dollar is stronger, right? And so if they've been buying US goods before, so let's say we are selling something, let's say we are selling iPods to the world, right? And what's going to happen is that the same amount of money that they've been spending to get, let's say 5 million iPods, all of a sudden it's going to be more expensive because comparatively, right, they've lost their purchasing power because the US dollar has become stronger. So when the US dollar becomes stronger, the purchasing power of the foreign countries decreases. When that happens, the exports decrease, so net exports comes down because countries can't buy as much anymore of the United States products. So if the net exports comes down, of course, the AD comes down, okay? And remember, the goal was actually to increase AD, okay? So this is the net export effect, and we talked about this in the last class, but it was a homework question. I thought it was a little important, so we went over it just in case. Moving on, we're going to talk about supply-side policies. So in economics, there are different economists that think differently. Some people think that we need to make sure that we're checking on aggregate demand as a tool to make sure that we get out of recession. Some people think quite the opposite. They think that instead of the AD, we need to be thinking about the AS, as in the aggregate supply. Okay, so now we're going to talk about supply side economics. Supply side, I'll just short econ, okay? Supply side econ, okay? So they're primarily dealing with AS. They're saying forget AD, it's all about AS. Because remember, we talked about this a little bit, but when AS goes up, it's sort of a win-win situation, guys. When AS goes up, okay, we say that the RGDP, right, goes up. Awesome, right? RGDP goes up. When RGDP goes up, we have unemployment coming down, of course, because there's more jobs in the economy. And as a result, when AS goes up, because of the way the graph works and it shifts, there's more supply, price levels actually come down. So RGDP goes up, price levels go down. A win-win situation, right? Because you get more out of your money and you're getting more money, okay? So that's awesome. And when it comes to aggregate demand, actually your price levels actually go up even when RGDP is going up. So supply side economists argue that AS is the better bet. So how do we, let's say that we're in a recession and we're trying to fix the economy. And so how does a supply side economist think? Supply side economists think that we need to make sure that we reduce the tax. Okay? Why is decreasing tax important? Remember, when I get money, okay, or you get money, let's say you're working at a job, right? You make $10. Let's say you make $10 a week, okay? In that week, okay, you get taxed 30%, okay? You get taxed 30%. So tax is 30%, okay? If tax is 30%, that means the amount of money that goes to the government, okay, is $3, right? 30% of $10 is $3, right? And $7 goes to you. So $7 goes to you as a person, $3 goes to the government, okay? So out of the $7, you have consumption and saving. Let's say you consume about $5, okay, and you save about $2, okay? Now, same thing, let's say you make $10 a week, okay? New scenario says that you get only taxed 20%. Supply side economists think you need to reduce tax, right? And they do reduce the tax and you make 20%. Now, 20% of $10 is $2, right? All of a sudden, you have $8 of disposable income, which translates to, let's say you consume the same amount, right? Consumption hasn't changed. You all of a sudden save more, okay? That saving has gone from $2 to $3 just because of the tax rate going down from 30 to 20%. Now, why is this important? Let's use a graph and actually understand this on the macroeconomic level. I just gave you an example to kind of see how that translates on an individual level. But what this really does is that this kind of translates on a graph and it's a lot more clear so that visually you'll understand what's going on here. All right, so let's start off with the market for loanable funds. Now, what's going to happen before I get into the market for loanable funds is that understand that, remember, when I reduced the tax, okay, when I reduced the tax, what happened was that your savings, or your S, went up, okay? And what that's going to do is when the savings go up, right, what you're going to do is, hey, you know what, I'm making X amount of money more because I'm saving more money, okay? And you take that and you put that in the bank, okay? And you save it in a bank, okay? So what that does, it increases the amount of loanable funds, okay? Because remember, loanable funds. Remember that when you take your money, when you save more, part of it goes to the bank, obviously, right? Or most of it. And when the bank, what it does is it's only required to keep a certain part of it in their reserves. And we'll talk about it a little more when you talk about banking. But what they do is they actually loan out the money, a part of it, to the people. And that goes into the market for loanable funds. So the amount of loanable funds increases when the saving increases. So basically understand that when the tax decreases, the end product is the amount of loanable funds increase. So now let's go into the market for loanable funds, right? Now you're talking the market for loanable funds. Let me erase this. so we can label the graph correctly, right? So we're talking about the market for loanable funds. Okay, and what do we have in a market for loanable funds? Let's start off with the two axes as usual. You have loanable funds here, right? The amount that are being loaned out. Loanable funds. And then you have your interest rate, okay? Interest rate, or I, okay? So again, you have a demand, right? And remember, guys, the demand in the market for loanable funds is the investment demanded. Okay, remember that? Investment demand, right? Investment demand is actually representing the demand graph, the demand function, excuse me, in the market for loanable funds. And the supply is the supply of loanable funds, right? Supply of loanable funds. Now, what do we say? When we said the tax went down, so supply side economists go up to the president and they say, well, sir, to fix the recession, you don't have to actually change, you don't have to spend more. What you actually need to do is decrease the amount of taxes. So the president says, all right, so he puts in a proposal and the Congress passes it and the tax rates go down, okay? Tax rates goes down, what happens is you get more money, all of a sudden your disposable income increases and you save more. And when you save more, you put more money in the bank. You put more money in the bank, what happens is the market for loanable funds, right? When you see this happen, when the bank gets more money, they put in more money into the market for loanable funds, and the supply of loanable funds increases, okay? So it shifts from S to S1. Now before, we were at this amount of loanable funds at Q1, and we were at this particular interest rate at I1. Notice what happens when the supply shifts to the right. The interest rate comes down, the amount of loanable funds obviously increases. Okay, so interest rate comes down and an amount of loanable funds increases. Now, why is that a good thing? Well, we talked a little bit before, but we said productivity is driven by a couple things. We said productivity is driven by the fact that when you invest in technology, when we invest in resources, when we invest in people, right, what happens is you become more productive, economies are better off, right? How do you get that money to invest? It is from this part, okay? It's from this part. It's from the market of loanable funds. This is where the firms, right? Remember, this is the amount of demand function in a market for loanable funds is actually the investment demanded by the firms, okay? So when the supply increases and the interest rates come down, remember the way that investments work, okay, is that there's a real rate of return for your projects and there's an interest at which you're borrowing at. Okay, if this interest rate is coming down, it's cheaper for you to borrow. Okay, it's cheaper for you to borrow, so you can go ahead and invest in projects. Okay, that all of a sudden are a lot more affordable to invest in because they're going to give you a higher rate of return than the amount at which you're borrowing at. Does that make sense? So when interest rates come down, it's cheaper to borrow money. So all of a sudden, firms can invest more, and when investments increase, the economy gets better because we invest in things like technology, we invest in things such as capital. Okay, so this is the general argument. So let's go ahead and switch gears and we'll go into a SRAS graph, right? So we talked a little bit about how if our loanable funds increase, we talked about the fact that interest rates, right? Interest rates decrease, and interest rates decrease, investment goes up. Okay, so if investment goes up, right, by different firms, there are a lot of good things that happen, right? They invest in things such as technology. What does that do? It decreases input prices, for example, right? So I'm a company, okay? Before I could, I make cameras, okay? I make cameras, and before I couldn't invest in high definition technology because it was really expensive for me to invest. However, because the taxes came down, savings went up. There's a supply increase in the market for loanable funds. The interest rates have come down. All of a sudden, it's cheaper for me to borrow. My investment banker comes in and he says it's cheaper to borrow, right? And I say, great, let's go ahead and invest in my project, okay? So I, as a camera manufacturer, produce HD cameras, right? But also in my technology, what I do is I realize that I can make certain materials in my camera for a lot cheaper. So what I've done is by increasing the amount of investments, I have decreased input prices, okay, by having better technology. If you don't understand this link, that's okay, But understand that what we're going for is we're going to shift the short-run aggregate supply graph to the right. So if you have this graph, okay, we have the real GDP, our GDP, then we have the price level, as usual, right? This is our short-run aggregate supply. I've not broken down to 3 zones. I've just had the middle zone, okay, which we normally deal at, where full employment is. Remember that? So let's draw full employment. Okay, this is your LRAS, which operates at RGDPF. RGDPF stands for GDP that's been producing at full employment. Okay. And now what's happened is I need one more component. I also need the AD graph to come in. I'm going to have the AD come in right about here. Okay. All right. So at this equilibrium, okay, my price level is at PL1, my RGDP is at full employment. Okay. Now look what happens when the input prices come down. Okay. My SRAS, my short-run aggregate supply, is actually going to shift to the right. Why? Because what's happened is I've invested in technology. Technology has helped me bring down the input prices. Input prices have made things cheaper, and I can supply more in the market. Okay, so this shifts to SRAS1. Now watch what happens here, is that my RGDP actually shifts to the right. Okay, and if this input prices, okay, have come down permanently, what's actually going to happen is that your LRAS is going to follow suit, and it's going to move right as well, okay? And so your full employment actually moves to the right as well. So LRAS moves from LRAS1 to LRAS2, okay? SRAS moves from SRAS to SRAS1. But it just depends if this input prices is permanent or temporary, okay? If it's only temporary, only the SRAS moves. If it's permanent, both the SRAS and the LRAS move. But watch what happens. Our GDP goes to the right, and your price levels come down. Okay, that's why supply-side economists think this is a win-win situation. Because when you deal with aggregate demand, what tends to happen is that your RGDP goes to the right, but unfortunately your price levels actually go up. Okay, your price levels go up. So for that reason, they argue that if you deal with taxes and you decrease taxes, right, your savings goes up. If your savings goes up, there's more money in the market for loanable funds because banks get more money. That happens, interest rates come down. It's cheaper to invest in the economy. People invest and they figure out ways to be more productive. Productivity means that your input prices can come down. My input prices can come down. What tends to happen is that my SRS will shift to the left, or to the right, excuse me. And if it's a permanent shift, your LRS shifts. Either way, you're having two things. One, your RGDP moves, right? Your real GDP moves to the right side, which means your output is going up. Good things are happening. Economy's creating more jobs. Economy's healthier, more higher output, more income. At the same time, your price levels are coming down, so things are more affordable now, okay? So that's why supply-side economists think it's a win-win situation. So that's a pretty important thing. Two other issues that they talk about, supply-side economists, two other things that are pretty important is that when you bring taxes down, right, and you bring we've talked about the link between tax and bringing interest rates down. When interest rates come down, people can invest, and that's really good for business owners, right? Because they're not afraid to take high risks. So they can take risks and take a loan, right? If you're a person who all your life dreamt about creating your own business and you wanted to borrow money, but you thought borrowing money was too risky and the interest rates came down, that's less risk, right? So it's more likely for you to go ahead and invest in that. And that's good for the economy, right? Because you're creating more business. So productivity, we talked a little bit more about productivity as well, because when taxes come down, it's cheaper to invest, right? And when you invest in different things such as technology, typically speaking, you can figure out ways to bring your input prices down, okay? And that's great because you can shift your supply to the right, GDP goes to the right, price levels come down. Again, a win-win situation. All right, so that's that for supply-side economics. I can't even say economics anymore. Economics. But for the next part, we're going to talk about finance and talk about financial assets and money. Exciting stuff. So for those of you who have already started investments and whatnot, I'm sure some of you at least know what stocks are, right? Pretty cool. The way you can invest normally is in the stock market. You go ahead and you purchase shares, right, of a company. So let's say you have a company like Google, right? You have a company like Google, and yes, the owners own a certain percentage, but once they go public, that means they offer a percentage of the company to you as a consumer. You can buy a share, right? So you can buy a stock. Okay? Stock basically gives you a part ownership. So you're a part owner of the company, right? Okay? The reason why Google offers stocks is that instead of going to the bank and borrowing money from them, and they don't have to owe money, right? What they do is that they just pick up money from you. So you say, hey, Google, as long as you give me 1/1,000,000, okay? It depends on how much money you invest. Obviously, if you invest $1 billion, you're going to own a bigger part of Google, okay? The point is that a stock gives you part ownership of the company. In return, you give them money, okay? So Google doesn't have to go and be in debt to a bank. They can just take your money. But at the same time, what they do have to give up is the ownership of their company, right? Now this is done in fractions, so they try to manage that as well. But this sort of financing is called equity financing because equity is the ownership in the company, okay? So this is called equity financing, okay? There's normally three parts to for a company. There are the assets, okay? There's the liabilities, okay? And then there's the equity. All right? Equity is the part that you own, okay? So if you've invested in Google, right? You're the owner of Google and you own 30% or whatever it is, that goes in the equity section. The amount of money that Google owes other people, right? So Google takes loans as well, all right? So if they have to take a loan, let's say they take $1 billion loan for a particular project, okay? They owe, let's say they took a loan from JP Morgan, okay, for $1 billion for a particular project. So their loans comes under the liabilities section. Okay, assets is what is owned by the company. So your machines, right? Computer, equipment, real estate, anything that you basically own, right, is an asset to the company. All right. Also, if anybody owes you money, right, they owe you money, that also goes under assets. Okay. So if I owe money to Google, that goes down as an asset to the company, all right? This is going to be helpful if you guys pay attention in understanding how banks value their assets, okay? So that being said, let's talk a little. We talked a bit about stocks. Let's go into the other part of investment. So say you think that stocks are a little too risky. You don't understand stocks, okay? So stock was equity financing. There's another type of financing called as debt financing, okay? Debt financing. So what is debt financing? Debt financing typically has to do with this word called bonds, okay? Not James Bond, bonds, okay? Bonds have to do with the fact that I'm Google, okay? And I talked about the fact that I need $1 billion for a particular project. Yes, I can go to the bank and borrow that money. That's also debt financing, but point is that Google can issue $1 billion, right? 1 billion in bonds. Okay? What does that mean? They're going to say that, hey, we're gonna create $1 billion on this paper, right? And we're going to say that basically it's an IOU paper. It's an IOU stamp for $1 billion. And over the next 5 years, we're going to pay you this $1 billion. On top of that, we're also going to give you interest. Okay? So what's going to happen is in those 5 years, they're going to make, depending on the way the bond works, right, and how it's been arranged, they normally pay, let's say, semi-annual payments, interest payments for you every single year, okay? So, and after that, after whatever the bond year is, say it's due in 5 years, after the end of it, in 5 years, they're going to pay you the principal amount of $1 billion, right? So, but all of this, right, at that point in time, you have to pay Google $1 billion. So in 5 years, you can get $1 billion and also interest on top of that. Okay, so they can issue bonds, and that's a type of financing called debt financing. Okay. Now, the one other concept that I want to jump into before I discuss more about money is a concept called time value of money. Okay. Now, I'm only going to explain this on a very simple level, so we don't get too caught up in it. Okay, but time value of money is a pretty interesting concept because money, like a lot of things in life, actually loses value in time, right? Now, why does that happen? Okay, let's say you take $100 and you put it under your mattress, okay? Or you put it in your desk or your closet, whatever. The point is that $100 is not invested in a bank, okay? Let's say that, well, you have to account for two different things, okay? You got to be thinking, what is that $100 worth today? What is that $100 worth tomorrow? And what is that $100 worth a year from now, okay? So first of all, we talked a bit about this concept of inflation, right? Let's say that $100 today can buy you 100 loaves of bread, okay? And due to inflation, right, bread all of a sudden has increased like it does all the time, right? And next year, you can only afford to buy 99 loaves of bread. Obviously, that $100 is not worth as much anymore, right? You've lost a loaf of bread, right? Might not seem like a lot right now, but the point is inflation makes value of goods, right, increase, right, at least on a nominal level, okay? So your $100 cannot buy you as many goods anymore, right? Another concept is the fact that if you had $100, right, instead of it in your closet, you take these $100 and you invest in a bank. And let's say the bank gives you 5%, okay, interest, right? 5% interest per year, okay? Right? So they give you 500 out of $100, right? What's the interest payment that you can get? Well, you can get a $5 interest payment, right? So at the end of year one, let's compare, okay? If you put your money in a closet, right? If you put it just still, I'll just put it still, right? You did nothing, okay? You did nothing. You would have $100, right? Because that's pretty safe. No one touches your closet, right? No problem there. But let's say you went to a bank. Let's say you went to a bank and they offered you 5% interest, okay? You actually would have $100, which you put in, right? Plus the interest that you got, which you made $105, right? So time value of money basically discusses the concept of the fact that there are two things going on. One, there is inflation going on, right? So constantly goods are becoming more expensive, right, on a nominal level, right? At the same time, when you can invest and you can get interest back, right, you actually can make more money sitting in other options. So time value of money is an important concept in your head, thinking that $1 today, right, is worth than $1 tomorrow. Okay, and that's why people charge interest when they take a loan, because they understand that tomorrow, okay, that loaf of bread is going to be more expensive, and they need a value for that. Okay, and one of the ways that people calculate the way interest works is, well, if I put it in a bank account, how much money could I be making? Okay, the other idea is, how much is this dollar actually worth tomorrow? Okay, so you have to adjust these two things in your head and think about this concept, time value of money. It's important understanding, just in case that, we're going to talk about a couple concepts in the future, but I just wanted to talk about it so that it's, settling in your head, because we're going to build on that. But basically what I want to go over right now is the review of the lesson, right? We start off with supply side policies. We talked about supply side economics. We talked about the fact that they love to think about AS, right, aggregate supply, and not aggregate demand. Okay, so they think that aggregate supply is the way to go. One of the ways you can fix aggregate supply is by decreasing the tax. Okay, So that is going to be your homework question, okay? So explain to me how supply-side economists can use tax decreases and basically increase the RGDP. So how do you increase the output using taxes? Okay, that is your homework question. I will see you guys in the next class talking about finance, money, and banking. Thank you so much for joining me. Take care.